running basically by George Soros, among other billionaire hedge fund managers. And that actually goes very much in line with a theme that I've been seeing talking to investors over the past, let's call it a couple of weeks or so, that have continued to basically position themselves buying index protection, so buying calls, call spread in the VIX, so the CBOE volatility index. And that's one of the things I want to consider here. Essentially, the talk has been over the past couple of weeks that a lot of the potential risk premium for the second half of June, where we have a bunch of events from the FOMC meeting to the Brexit vote, and even starting this weekend, actually, this European Soccer Championship, which some people are actually saying there may be some terrorism threat there. So there's a lot of potential risk premium that actually hasn't really been priced in, and that makes me look at the VIX here for buying some index protection. So let's have a look at what that might look like back here on the screens.
So here we have the VIX, the CBOE S&P 500 volatility index, measuring the implied volatility in the S&P 500 options. And you can see basically, on average, when the VIX drops below 14, 13 or so, it's usually a pretty good time to buy volatility, or implied volatility, to be more specifically. Now, I will say this. I think, just like most other things in trading and investing, people make this volatility thing, implied volatility thing, way too complicated. Okay, so let's quickly start with where we are right now, and then we'll talk about how to sort of simplify this. So first of all, we see over the past few days is that the implied volatility has actually been bid higher. You see this little rally here in the VIX? Well, stocks at the same time actually also rose, right? So that's giving us some positive divergence between, well, actually it's not giving us any divergence. It's basically giving us a correlation, which tends to be a little bit cautious, right? So basically, investors have been buying the VIX. They've been buying up protection because they're getting a little bit nervous. But the S&P 500 has been pushing higher at the same time. Usually, implied volatility gives you the truer read of what's taking place. Okay, so that's sort of what's going on right now. Now, in terms of the risk management, and considering that, again, looking ahead to the second half of June, we have the FOMC, we have Brexit, we have this European Soccer Championship kicking off this weekend, and we have a bunch of other stuff in there between more Fed members speaking and all sorts of stuff like that. That, to me, when I look at a VIX this low, that's still, as of this writing or as of this recording, still below 15, that to me speaks to complacency in the market. I would think that at least some sort of risk premium should start to get priced in here, and maybe, just maybe, we saw a little bit of that take place here over the past few days. Now, the thing is about the reward to risk right now, if one were to put on this trade, there is a pretty clear stop loss. So if the VIX drops back below 13 at the very latest on a daily closing basis, then I think you just basically stop yourself out, right? That's your risk. Your reward, I think the VIX, if things go just a little bit where they should go, could easily get back towards 17, 18, maybe even 20, right? So that's your upside in the VIX. So nice and easy. Buying some index protection is what I'm doing here. I hope this makes sense, guys.
So that's it for today's study trading vlog. I'm going to go hit the gym. Please follow me on the YouTube channel. Please follow me on Instagram, instagram.com/studytrader. And I'll see you guys in the next video.